To the Financial Freedom Show. My name is Rob Berger, and hope everyone's having a good night. I already see some great questions coming through. I've copied them into a Google Doc so that I make sure I have all of the pre-show questions. Someone give me a thumbs up. Just let me know everything's good. And in terms of audio and video, if you're new here, so this is, a live show I do every Monday from 7 to 8:30. I usually talk about one topic to begin with, and I answer your questions that you leave in the chat. If you have a question for me, and hello, Noreen, good to have you. Sean, thanks for the thumbs up. If you want me to discuss a topic or you have a question, just put at Rob Berger, because that way you guys can, chat back and forth between one another, which I'll don't ignore all that stuff, but I do try to get through to the questions as quickly as I can. The topic I wanted to talk about today, before we jump into your questions, it's this idea. I've received a ton of email from folks. Obviously, it's been a difficult year in the market, depending on your perspective. But the market's obviously been down. Stocks, bonds. We've got a lot of inflation, and I've received just tons of emails from folks just starting their investing journey and in retirement, really afraid. And should I change? Should I sell this? Should I go to cash? What should I do? And then sort of the flip side of that are the people that go back and look at videos I produced a year ago, where I might say, you should hold as little in cash as you can get away with. And they like to come in and say, how's that working out for you now, Rob? Right? And it's gotten me sort of really puzzling through this question of how to become what I call a buy and hold investor. You invest in something and you hold it for a lifetime. You might change your asset allocation as you near or in a retirement, because of, you're going to start spending the money. But by and large, you've got some investment plan and you're going to stick to it. You're not going to change it because the market is going crazy. It's a good market in the sense that prices are going up, and you're not going to change it because prices are going down. And I don't have all the answers to that question, because to me, it seems so obvious. I can't think of investing any other way. And frankly, this year, I can honestly say it has not been hard at all to just stick to my investment plan. I'm not saying that circumstances couldn't conspire in such a way where maybe I would find it really difficult. But I mean, it's not even been an effort. I haven't thought twice about it. And so I've been trying to puzzle through that question. And I've just got a few observations. I've even thought about, should this be the subject of a book? But the first one is, there are some people that just think buy and hold investing is silly. They think it's absolutely insane that you wouldn't adjust your portfolio based on economic conditions. And there are plenty of them. You'll find many of them, on financial news sites. They get interviewed, and some of it's very subtle. Sometimes it's like, what are you doing in light of inflation? Well, I really think you need to focus on defensive stocks, whatever that means. By and large, they mean stocks that aren't quite as volatile, I think. But what does that comment really mean? Are you selling half your portfolio to put your money in utilities? Or I don't know. But it kind of, the implicit thing is, we have a different economic environment. We've got to change our strategy. And I've never believed that that's a good way to invest, in part because it's really difficult to predict, how interest rates are going to change, when they're going to change, or inflation, or even, the exact contours of a recession. And even how that will impact, the market. And as soon as you think you've got that figured out, something in the world happens crazy that affects the market. And so, so part of the challenge is just figuring out a way that I can make the case that we really shouldn't be investing based on our views of the current economic cycle. And a lot of people disagree with that. I've got a good friend who's, he's hedging everything. He's got puts and calls. He's hedging. Other people, big into gold. They're going to hedge something. So that's the first thing. I mean, what's your investment philosophy? for those that sort of agree with me that by and large you shouldn't try to predict and position your portfolio to handle whatever you've predicted, then you've simply got the people call it greed and fear. Maybe I guess those are the words to use. I'm not sure that's exactly right. Certainly on the fear side, it probably is. And that's particularly true as you near retirement, because and you move into retirement, you're not making income. So you're living off of this nest egg and you see it down 20% this year or whatever the number is. And that really is difficult to stomach. And I get that. But I do think there's a lot of things that we can do that help. And a lot of it has absolutely nothing to do with the portfolio itself. I mean, certainly part of it does, having the right or reasonable asset allocation to begin with. If you went into retirement with 100% in stocks, and now you're sort of regretting that, well, that was probably too rich, too risky. So part of it is having a reasonable asset allocation. I think part of it too is whatever the asset allocation is, having the kinds of investments that you can stick to. To me, I think for the most part, that's index funds. I don't have to worry about the manager of the fund, making a huge mistake or just losing their touch. I don't. It's an index fund, so it's just following the market. So part of it's that, but I think part of it is all of the things about your finances in your life other than your portfolio, like how much debt do you have? In retirement, how much of your portfolio do you need each year to live on? These sorts of things, I think, go a long way to sticking to an investment plan. Part of it too, then, is, and I'm almost done with this. I appreciate your patience tonight. Okay. Understanding two things. One is understanding history, the history of the stock market and seeing what happens and why it happens. The things that are happening. What's happened in the market shouldn't surprise us. That's not to say we could have predicted it to the day and to the extreme, but interest rates were historically low. The monetary policy was very accommodating. Fiscal policy, I mean, the government was just pumping, trillions of dollars into the economy. At least in hindsight, it shouldn't surprise us that we have high inflation, that the Fed is now battling it by raising interest rates, that rising interest rates bring down asset values. That's just kind of, it's like saying gravity causes the apple to fall from the tree. I mean, that's just the way it works. And understanding that these things go in cycles. It's not always bad forever. I suppose we could imagine a scenario where something just beyond anything that we've experienced changed life as we know it on this planet. Although if that happens, I don't know. I'm kind of thinking our live show every Monday at 7 p.m. either won't happen or maybe it'll be, a different conversation. So, but understanding sort of how the market works, but then also understanding that what we're investing in are actual real businesses or a collection of businesses. And it's funny to me that I don't think people by and large treat actual businesses that they may own like so many people treat the stock market. I mean, I've owned businesses. Maybe you have too. I've owned real estate as investments. I didn't, try to hedge it. I didn't sell it as soon as I thought values went down. I ran it as a business. I didn't think about it that way. I think we think about it differently because we see those prices change every second during the trading day, and because we can sell it so easily. Just click a button, on the computer, and you've sold it. You've sold millions of dollars if you want to. And I think if we stop thinking about our investments that way and thinking about them as real businesses, because it's what they are, I think it leads to better long-term results. Anyway, those are my thoughts on that. Feel free to tell me why I'm completely misguided. While you're doing that, I'm going to answer some questions. I'm going to start with Kathy. You guys ought to take a lesson, learn from Kathy. She was on at 6:44. Now that's true commitment. And she said, I am retired and have about $500 a month I can invest in a stock fund. Per portfolio visualizer, a single S&P fund does better than a 3-fund index. So she asks, why do a 3-fund portfolio? That's a great question. So the first question is, or thing to keep in mind when we say it's done better, over what period of time? There are times when it wouldn't have done better, right? And long periods of time, like the first decade of this century, for example. If you looked at 2000 to 2009, I'm pretty confident in S&P. We can look at it together. I could be wrong. Oh, technical issue. Hang on. Be right back. I'm still here. I'm just behind, not in front of the camera. See if that worked. There we go. All right. Okay. So here's Portfolio Visualizer. So we can we'll do asset classes rather than specific funds. But she said S&P 500, so we use U.S. large cap. That's the S&P 500. And then over here, we can actually throw in the three fund bogleheads. There it is. Now, this has an 80-20 allocation. So in other words, 20% are in bonds down here. We'll just leave that. It doesn't have to be 20%, right? A three fund portfolio doesn't tell you how much should go in each fund. But this is sort of how Portfolio Visualizer starts. That's fine. So if we just hit this, I mean, the S&P 500 is going to crush it. Yeah. So this goes. When did this go? 1987. So 10,000, and the S&P goes to 308, and the three fund goes to 148. Now, the big question is why, and there's probably two answers, right? The first is the three fund portfolio has 20% in bonds, and we know long-term bonds don't have the same expected return as stocks. And that raises the question of why bother with bonds. At least in the case of folks in retirement, the answer, I think, is because you want to dampen the volatility of the portfolio, particularly since you're going to presumably be spending money out of the portfolio every year. Of course, if you have some money you're investing in, I don't know, you're going to leave it to loved ones or to charity, you're never going to spend it, well then, yeah, maybe you don't need bonds. But that's the general theory. And if you look at like some sort of safe withdrawal rate, say the 4% rule, or there are many others, they're generally looking at an allocation of 50 to 75% in stocks. If you go, which means up to 25 to 50% in bonds. The problem in retirement is that if you go 100% stocks, whether it's the S&P 500 or some other combination of equities, is that we could have something like the Great Depression, at least in theory, 1929 to 31, markets down by a truckload, call it 90%, something like that, and that would wipe out a lot of retirees if they were, say, 100% in stocks. All right, but the other issue here is we've got 30% in international, and by and large, international has underperformed the U.S. certainly in recent times. Now, I predicted, or guessed, I guess is a better word, I guessed that if we looked at a decade, pick the right one. Now, I could be wrong here. It's like I tell my wife, I could be wrong. It has happened once before. Yeah, she sticks with me. I don't know why. Anyway, let's see. I'm right. Boy, that looks ugly, doesn't it? Can you see those numbers? So 10,000 after a decade turns into $12,636 with the three fund portfolio, and it's actually lost a bit down to 9,000 with the S&P 5. Well, what's called the U.S. large cap, but that's effectively S&P 500. Now, by the way, in this decade, international outperformed U.S. Right. So if we come back up here, for example, and we get rid of the three fund portfolio, and instead we'll just put it all into a global portfolio that excludes U.S. Right. We compare these two. Yeah. See, they still outperformed. International did for that decade. And of course, some could say, well, that's just 10 years, Rob. Don't we want to think longer term? Well, yes. Although if you're retired, and Kathy is retired, again, I don't know if she's spending this money, but a bad 10 years, particularly early on, I mean, that's really sort of the whole reason the 4% rule exists, because of the sequence of returns risk. And so you've got to care about 10 years. If you're 25, frankly, for the next 10 years, assuming you're going to retire, whatever, at 65 and you're accumulating, You hope we hit the worst bear market we've ever seen, because you'll just be investing every whatever month or quarter at really low prices. So that would be great for you. But for old people like me and Kathy, I'm not saying you're old. You could have retired at 32. Wait, and I'm not saying 32 is old. Okay, whatever. I don't even know. Anyway, when you retire, you got to compare. You've got to be concerned with those 10-year periods. I mean, we don't have that many of them left when you're my age. So the point isn't necessarily that you should have a 3-fund portfolio, but I do believe personally that putting everything in just the S&P 500 is just not for me. By the way, that's the Warren Buffett portfolio, right? He's 90% of it, the other 10% in government bonds. So, you know, I've heard he knows a thing or two about investing. So maybe you ought to listen to him. I don't know. Okay, that's question 1. Whew. Number 2, Michael. Great IBond video the other day. I did an IBond video on how you can use buying IBonds as gifts to take advantage of the 9.62% rate that expires at the end of this month, actually, which you can check out. Anyway, question. Can you withdraw interest only after the first year, knowing that they still will withhold the 3 months interest? I'm not sure I follow the question. So the deal is you can't take anything out of the iBond for the first 12 months. And then after that, you can take, I don't know that it's distinguished between interest and principal. I've never actually cashed an iBond, but you can take money out after a year, but you'll be penalized 3 months interest until you've held it for 5. I don't know if someone in chat will know this. I would guess you have to cash out the entire iBond. But I don't actually know that. I've never actually sold. I bought my first iBond in 2013, and I still own it. See, buy and hold. There you go. So I don't actually know. I've not tried to sell. In fact, for all I know, they won't even they'll give you your money back. Maybe the government stiffs you. Maybe it's a big Ponzi scheme. I doubt it. Okay. I don't know why I'm like fired up today. I mean, I do have a drink, but trust me, it's just water with a little BCAAs. And no, that's not alcohol. All right. Michael wants to get in a second question. Your thoughts on BLNDX. It's a blend of 50% U.S. and international index funds and 50% commodities. It is a trend following fund. I'm just not a big fan of that sort of thing. And I wouldn't want to put 50% of my money in commodities. Anyway, in the right environment, well, maybe this year it's probably done better than the S&P 500. I would guess. Another opportunity for me to be wrong. Let's find out. BLNDX. We'll just use Portfolio Visualizer again, but this time we'll go. I'm going to guess it's outperformed the S&P 500 this year. Let's try that again. So we'll go stick with 2022. BLNDX. It's just because commodities, right? I mean, they've kind of been up, so it's not really, that's my basis for guessing this. But what do I know? We'll just use VU for our S&P 500. Whoops. Here we go. And yeah, it's been up. I mean, it hasn't had a great year it has had a great year. I mean, 3.31% is not a lot when you think about historical norms, but I'm pretty sure it's better than a negative 2391. And look at its standard deviation. Now, long term, I don't know how long that fund has existed, but let's just scoot back to 1985. It's probably only a couple of years old, would be my guess. Yeah. See, another guess. I got it right. Wow, I'm 3 for 3. So it's actually outperformed since 2020. I'm guessing, let's look at the year to year. So it underperformed in 2020. Yeah, all of its its outperformance is because of this year. And that kind of makes sense if it's 50% commodities, right? Although commodities have pulled back and, are we going to go into a global recession and then no one has any money to buy copper and corn? Well, hopefully we can buy food. Well, copper for that matter. I'm told it's kind of important. Anyway. Roy wants to know, what is your opinion on brokered CDs? The ones I see at Fidelity look very attractive. I think they're great. I think they're great investments. I'll show you the Fidelity. I don't own any. You have to remember, you have to think of them like bonds, right? Because a brokered CD, the way it would work, Fidelity effectively buys the CDs from a bank and then divides them up and sells them to investors. And then investors, then they can trade publicly, right? They never go back to the bank. It's not like if you want to sell, you have to pay the bank's penalty for an early withdrawal. It doesn't work that way. It's like a bond. The point being that the value of your seed, let's say you put 10,000 in, well, the actual value you would get from it if you sold it will almost never be exactly 10,000. If interest rates have gone down such that your CD is paying a higher than market interest rate, because assuming it's fixed, you'll get more for your CD. You'll get something greater than 10,000. If rates have gone up, so you're now earning a below market interest rate, then you'd have to sell it at a discount, right? But when I look at these rates, and I've looked at these, I looked at them yesterday. I don't know why. I did. Here we go. Let's see. So here it is, this CD right here. So 9 months is 4%. Now I really like the U.S. Treasuries here. See, I would probably go with Treasuries, at least shorter term. I don't know, longer term. I probably wouldn't. I don't know. I'd be a little worried about locking my money away for 5 or 10 years right now. But well, maybe just about any time. Well, not 5. I guess that's like an intermediate term. But in any event, they're decent rates. I like the U.S. Treasuries better. It's probably what I'd go with, but they're good. And they and they beat the no penalty CDs that we've seen from Save Better, which I think are at 330 or the highest. Of course, the one thing about a no penalty CD is that they're not subject to interest rate risk, right? You could cash out anytime you want, and in that case you're selling it back to the bank effectively. Selling it's probably the wrong word, but the bank is paying you, giving you your money back. And you're always going to get face values with a bank CD. That's true whether it's a no penalty or something else. It's just with no penalty, there's no penalty. But 4% or 4.22 on a Treasury bill, for 9 months, seems like a pretty good deal to me. I mean, relative to our other options. Okay. Mike says, buy and hold definitely still works. This market isn't the worst I've seen. Buy and hold got me through worse than this just fine. Yeah, it's definitely not the worst I've seen. It's not even close yet. Could be. We'll see. Kim says, I thought we pay tax on IBonds in the future when we redeem them. Yes, that's true. Someone said there's another way that they can tax you annually. I think there is. I think you can elect, actually. Once again, I may be wrong. And there could be reasons to elect, possibly. Maybe if your tax bracket's really low this year. I don't know. All right, next question. I could show some. I can't show these on screen, by the way, or I would. All right, let's see here. Bob says, do you subscribe to the idea that not being in the market on just 2 or 3 days in a year can make a big difference in your return? Well, that's an interesting question. They'll often say this: if you miss just the 5 best or 10 best days over such and such a period of time, you would have gotten your returns would have been far less. Mathematically, I have no issue with that. I'm assuming the people that say that have done their homework and they get it right. The problem is that the very best days in the year are usually either follow or come right before the worst days or really bad days. And we've seen that happen. It happened when we had the COVID pandemic crash. And it's happened last week. There was some bad day, good day. So as a practical matter, I don't know that it tells us a lot. I'm a buy and hold investor, and I think that's the right approach. So if that kind of thinking helps people stay invested, I'm all for it. But the one thing I think it misses is that if you're out of the market on the best days, you're probably out of the market on the worst days too. Anyway, that's my view. Let's see if I caught up so that I can show you the questions. I think I have. I have. Okay. Let's see. Chris asks, does it make sense to cash out dividends and cap gains on a taxable account to move to another taxable account you want to increase the position in? Well, no, not in my mind. I'm assuming you say cash out. You're going to, well, wait a minute. Let me back up. So, well, there's two things. There's dividends and there's cap gains. So it's a taxable account. You've been distributed dividends. So they're taxable anyway. So you can do whatever you want with them. And, you know, if you take them out of, I don't know, Fidelity and move them over to Schwab, you're going to pay taxes whether you leave them in Fidelity or move them to Schwab. Now, I don't know why you want to move them to another taxable account and invest in whatever over there, but I'm sure you've got a good reason. Capital gains, if you're talking about capital gains distributions from a fund where they distribute capital gains and you're going to get taxed on it anyway, and you haven't reinvested them, it's kind of the same thing, as far as I know. Although I haven't invested in a mutual fund that actually distributed a capital gain as long as I can remember. I'm sure I have if I go back far enough, but I haven't. I mean, probably a decade or more. Now, on the other hand, if you're talking about selling an investment and that triggers the cap gains because you want to take that money, move it to a different taxable account and invest it, that doesn't make as much sense to me. Well, certainly it doesn't make sense if you're going to move to another account and invest it in the same thing, right? Because you could just leave it where it is, not sell it, not take the cap gains, and move it in kind and not incur the taxes. But I'm guessing that's not not the situation you were talking about. So I hope that's helpful. Yeah. All right. So Zach wants to know thoughts on VU, AVUV 50/50. So VU is an S&P 500 ETF by Vanguard. Low cost. It's great. AVUV, I actually just bought some AVUV. I'm not completely sold on it. I bought a very small amount from dividends in a retirement account, but it was very, very small amount. And it's a small cap value fund. But I take no issue with that fund. Obviously, I bought some. But 50/50 for me is way too aggressive on the small cap value. I'm not saying it couldn't work out over the right time period. I certainly couldn't. I don't think I've ever owned more than about 10% of my portfolio in small cap. I'm not saying that's the right answer, by the way. That's been my answer. It's hard for me to imagine putting 50% into small cap. There you go. Vinyl, I don't think that's possible, is it? Listen to this. Vinyl says, and by the way, Vinyl is shorthand for Vinyl One Earth Link. You should read our chit chat and see if anyone is giving out better financial advice than you are. I mean, that hurts. I'm not going to lie. By the way, this isn't financial advice. This is entertainment and maybe education if by accident I happen to educate someone. So you guys give all the financial advice you want. I'm just pontificating. Kelly wants to know if there's been any update on the Fidelity ZERO funds since your video of 8/2021. Not that I know of. I think they're the same funds as they were then, as far as I know. And my views of them haven't changed. I don't think they're bad funds. They don't track, they track Fidelity proprietary indexes, which I'm just not a fan of. Others do that, right? SoFi's robo-advisor, they have some of their assets in a SoFi sort of index. It could be fine. Maybe I'm making a mountain out of a mole. I don't know. Mountain out of a molehill. But okay. So Red wants to know, are you going to update the issues buying IBonds for someone who is already at their limit? I'm not sure what you mean. So if you could be more specific, I can answer your question. So Greg says something, and I don't disagree with this. An investment philosophy should only be evaluated for no shorter than an entire market cycle, not just 1 year. I don't disagree with that, and I would say even longer than that. But yeah. So this is the chit chat. You got to sell at some point. I'm not saving for my funeral. That is true. You do have to sell at some time. The question is, why are you selling? If it's to spend your 4% or whatever it happens to be a year, then that's a good reason to sell. Okay. So PhD Angel says, I want to rebalance my portfolio and was thinking about selling assets in red. I assume they've gone down in value, and buying assets that are even worse in the red, gone down in value even more, particularly reducing my bond positions. Make sense? Well, my question to you is, do you have an investment plan, an asset allocation, and are you rebalancing back to that plan? Or are you changing your plan? Kind of sounds like maybe you're changing your plan by reducing the amount you have in bonds. I personally wouldn't do that. That's not to say you shouldn't, but the lower prices go, and stock and bond prices have both gone down, the more attractive the investment becomes. I was looking at, see if I can find it real quick. Yeah, the bull bear ratio. Let me pull up let's see here. Here it is. So this is the American Association of Individual Investors. And they take some sort of survey, I guess, of their members. And they ask them, basically, I think it's a 6-month period. I could be wrong about that. I think it's 6 months. Yeah, next 6 months. And they basically say, do you think stock prices will be up or down 6 months from now? And then they track it. The interesting thing is, you'll notice that as of 10/5, that's the most recent data, 54, I will call it 55% of those surveyed were bearish. Prices will be down. And you come over to this little dashboard here, and it's green. Like, that's a good thing. What's going on here? Well, what they found is this is a contrarian indicator that if the more people are bearish, the more likely prices will actually be up 6 months from now. And there was an article. Let me see if I think I can find it. Oh, here it is. I don't know if you can see this. This is one of my many note-taking apps. This came from this article from Josh Brown. I'll just look at this article where he was looking at the S&P 500 6-month gains versus the AI bears. And if the bearish sentiment's greater than 50%, the average increase in the market was almost 6% over the next 6 months. I just find that kind of amusing and informative. All right. David wants to know my thoughts on Wealthfront versus Betterment. I like them both. I've used them both. By the way, I just moved all my money out of Betterment. I was done testing it, with my credit card rewards. I did a video on it for you. I don't have anything in Wealthfront. I could put something in there and then do a video on Wealthfront. I used to have a SEP IRA there many, many years ago. I lean towards Betterment between the two. I do, if for some reason you think you need direct indexing, and I did a video on that, I think most people don't. Wealthfront offers that. But I think they're both reasonable options for a robo-advisor. I like them both. I would probably pick Betterment between the two. It just has more features in my view, at least based on my use of them and what I know of them. But it has been a while since I've used Wealthfront. Remember to tag me if you want me to read your comment. Someone wants to know why IBonds don't show interest payments on Treasury Direct. Well, they do, at least in terms of the balance. I'm trying to remember if they break it out. I don't know that they break it out in terms of actual interest, like, line item. I can't remember. But I was just in my account this weekend because I was updating my, the investing spreadsheet that that I have talked about in the past. One thing I did, I haven't done it on the publicly available version, but I did set it up so that you can track balance funds that, or target date funds that have multiple asset classes in them. And it was a very simple approach, maybe not even the best one. But what I did was, and I'll do a video on this, I just added a column. So the idea was, so my first thought was, well, I'll just have multiple rows. Like, let's say you've got a balanced fund with, we'll just say stocks and bonds in it, and it's 50-50 or something like that. You could just do 2 rows and then figure out, how many shares you have in it, and then just have 1 row with 50% of the shares. 50-50 is a bad example. Let's say it's 60-40. 60% of the shares in the first row and 40% of the shares in the second. But then I thought, well, then you're doing all this math to figure out how much shares, the number of shares to put in each row. I didn't like that. So what I did was added a new column, and it's just percentages. So I can just go to, like, if we go to, like, we'll use Wellington as an example. So before I show you this, so like well, no, let me show it to you first. I'm trying to figure out which way would be easier. So here's Wellington Fund. If we go to portfolio, okay. So, okay, we got 65.19 in stocks, 33.57 in bonds, 124 in short-term reserves. So in this case, I probably wouldn't distinguish between reserves and bonds. I'd put them together. You wouldn't have to, but I'd have 2 rows, one for stocks, one for bonds. In both rows, I put the total number of shares that I have, but I've added a column that allows me to put percentages. And so for one, I'd put 65.19, and for the other one, I'd add these 2 together. Obviously, it's just the difference, 34.81, I think. In any event, in the second one, and then in terms of the value, I just change the formula to include multiplying by the percentage. I hope that makes sense. It probably doesn't. I don't know if rewinding and playing what I just said in slow motion will help. Probably won't. I will do a video. I'm going to update the spreadsheet and I'll do a video. People have asked about that. Anyway. So Ronan wants to know, would it be a mistake to sell total bond fund at 15% loss to buy TIPS or IBonds? Well, TIPS have been down this year too, by the way. IBonds don't trade publicly, so it's a little different. Doesn't mean they can't fluctuate in value. It's just that you don't see it. I personally don't like changing my asset allocation, and I view that as a change in asset allocation. Maybe not the most dramatic change, like going from stocks to bonds or bonds to stocks, but I don't really like to change the construction of my portfolio like that during times like this. If things have kind of been even keel, not crazy good or crazy bad, and I want to make an adjustment like that, I do it. I personally don't do it in times like this because I'm always concerned that I'm doing it because of what the market has done as a reaction to the market, and I don't want to do that. Now, but again, TIPS I think a good investment. I have TIPS. I have nominal bonds like the Vanguard Total Bond Fund. I have IBonds. So it's not that I think they're all good in the right context. I don't like to make those kind of changes when we've seen the market turmoil that we've seen. That's my view. What's next? Gary, I don't know the question. Should I exchange? Maybe there's another part of your message. Maybe I'll come to it. So Clarice says, another great Sunday newsletter. TY, is that thank you? I don't know. Or is it Ty? I'm not sure. By the way, I do send out a newsletter every Sunday. You can get a link to sign up to it below this video. It's a lot of fun. I enjoyed putting that newsletter together. Anyway, I did read the Morningstar article on international. Are you still on board with 20% VXUS? I am. Yeah. That's my approach. I don't have VXUS because I tax loss harvested out of it like at the end of 2018 when the market was crazy. But it's interesting. I'm in a different Vanguard fund, but it was actually showing an unrealized loss of a few thousand. It might be back down to that after today. I don't know. Although I don't reinvest dividends, so I still have a positive return overall. But I thought that was interesting because it was up a lot at one point. Not as much as the S&P 5, or I don't have S&P 500 there. I have total stock market, but in any event. So, question by Adavandaya, I don't know, can't pronounce it. Question on IBonds. Given the current interest rate of 9.62 and the next 6 months might be around 7%, seems like a good guess to me, and lower after that, yeah, could be. Do you think of selling IBonds in the future when the rates go down? Well, I certainly can consider it, but I don't think I probably will, because I like IBonds as part of my overall bond portfolio, even though it isn't a taxable account. But I can defer the taxes until I redeem them. So I probably won't, but we'll see. I mean, they're inflation protected. The problem is the fixed rate is 0%. Well, for mine. If some of you that have had your IBonds longer, and actually since 2013, I think there have been some periods that had a fixed rate above 0%. Let's see. IBonds fixed rate. I think they have, they show a history here. See if I can find it real quick. Yeah. So there have been some fixed rates above zero since I bought mine in 2013. They've been 0%, but you see here 0.2, 0.5. I bought mine. I must have bought mine before the November 1. I guess somewhere in here or here. But if you go back further, look at this. 140. It was higher than that at one point. 162, 3. You know, I mean, you had to live through a lot of low returns at times, but look at those fixed rates. It's not too bad. And I know people that have IBonds that they bought them back then. They're making 12%. But I don't know. I'll decide when the time comes based on what the rates are doing and what other rates are out there. But I'm not in a hurry. So we'll see. I could very well hold them for a long time. All right. Great question from Daniel. For brokerage taxable accounts, how do you approach rebalancing? My approach is not to rebalance in a taxable account. That's what I've come to that decision. I'm not going to incur taxes to rebalance in a taxable account. And I think I won't need to. I think I can rebalance sufficiently in tax deferred accounts such that I don't have to worry about it. Yeah. Jeff had problems buying IBonds last night. Error message along with, I don't know. I guess keep trying. I've had a couple of people email me to say they were trying to buy the bonds, as a gift, and they ran into trouble. Others have emailed me and said they did it and it was great. I have not done it yet. As I mentioned in the video, I'm going to wait until probably I'll be at the Boglehead conference later this week. So it'll probably be next week. All right. Ethan wants to know, what would you say to someone who is struggling to stick to a workout routine? What would you recommend? Well, I guess part of the reason would be why they're struggling. Was it a time issue, or maybe they got plenty of time and they're just not working out? So that would be the first question is what the problem is. Then one thing I would do if I needed to would be to pay someone, right? Pay a trainer, make an appointment, because you don't normally blow that off. And I really got hooked into, fitness when I joined a club 2010, where you made an appointment, you went in, it's semi-private. So usually it was a class of like 5 people with one trainer. You had your own workout. So they customized my workout for me. And then the trainer would walk around and help people spot them, answer questions about an exercise, but you were making an appointment. Of course, it costs more money, but I stuck to it. And then what I found is once you start to see results, then the motivation sort of kicks in and it kind of feeds on itself. But I would spend money if need be to stay committed to it. The other thing could just be a different kind of workout. Maybe you don't like getting on a treadmill. I mean, who does? But you love playing soccer or racquetball. That's the one thing about my workouts that I don't like, is that I would prefer to have part of my routine involved in playing some kind of sport. Every now and again, I play volleyball. I usually hurt myself when I do. Last time I played, I tore a meniscus. And I wish I had a great story. I was going up for a spike and I scored the point, but came down and no, I stepped forward. Ridiculous. Didn't jump, didn't twist, didn't fall. Anyway, those are some ideas. I now work out at home and I do Pilates twice a week. I don't do the Pilates at home, but I'm paying someone one-on-one Pilates. Man, I'm not mobile either. Whew. It's not pretty. And in Pilates, I mean, there are ways to accommodate folks like me who are about as flexible as a 2x4. But yeah, it does make some of the movements not very pretty. Okay. All right. By the way, I love non-financial questions, so feel free to ask them. Looking for, let's see, remember to tag me if you want me to talk about a topic. This is a good question. So Gary wants to know this. He says, Fidelity PP&A, I have no idea what that stands for, but I think it's just their advisory service. Had me in some really high expense ratio funds in my 401k. I took it over myself, and I'm wondering if I should exchange out of the high expense funds while they are down or wait. So I've gotten this question in different variations of it. So let's imagine you're in some actively managed US large cap fund, and it's down, whatever, 25%. And you want to move to, we'll call it a total US stock index fund. To me, there's absolutely no reason to wait. And it's, people, I think the concern is I'm locking in my losses, but you're not, because you're taking the money and putting it immediately into a fund that invests in the same kind of asset. It invests it in a different way. It's an index fund, say, versus an actively managed fund, but you're moving your money into, from one US large cap, and I'm just making this as an example, but one US large cap stock fund into another. So you're not locking anything in. I mean, yes, you're changing funds, but by the way, I think the whole locking losses in anyway, you've got an asset. It's worth X right now. It's what it's worth. Doesn't matter what it was worth a week ago. In my view, but I don't see any issue with going from an actively managed fund to the same asset class, but moving it over to an index fund. They're both down, right? I mean, everything's down this year, just about. Anyway, that's my view. So Ashish, this is kind of the thing we've been talking about at the top of the show. The question is, as a new investor, I created a supercharged, which I don't know what that means, but a supercharged 5-fund portfolio with 100 grand in late February 22. But now with markets at 2-year lows, is that true? I guess they are. Yeah. Will it make sense to sell the equities and rebuy them at such a low price? So you're going to sell them now and rebuy them when? That would be the question. I wouldn't. I mean, the market could go down further, but I don't know that. And even if it did, you'd then be stuck with the question, well, when do I buy them back? And the odds of you actually getting it at the bottom are pretty slim. So I just have never found, for me, I just don't view that as a long-term successful way to invest. But that's just me. Kathy, you are not old. Okay. So, Ethan, FXNAX has half the holdings of VBTLX. Is this a problem for those of us in the Fidelity Fund? I doubt it. These are both bond funds, right? FXNAX, U.S. bond fund. Let me pull these both up, and then I'll show you what I'm looking at. The reason I don't think, my initial reaction is no, and part of the reason, so one could argue, well, let's first look at the holdings. Let's first confirm this. So here's the Fidelity Fund, and if we go to portfolio, we can see how many bonds it owns. Well, I'll get what, 6,000, 7,000? What is it? Did I miss it? Where is it? That's weird. Let me go over to the Vanguard one. They used to tell you. Am I just missing it? Could happen. Oh, here we go. 17,000. Yeah, I was missing it. All right, there. 8,000. I don't know. It'd be interesting to look into why that is. I don't have an answer. I don't know. But here's why my initial reaction is that just doesn't matter. First of all, well, let's start with duration. Fidelity is 630, 629. And this is 667. So they're basically the same. Duration is a measure of interest rate sensitivity. As a general rule of thumb, it means that if interest rates go up by 1%, the value of the fund will go down roughly by 1% equal to its duration. Hope that makes sense. And the reverse is true. Rates go down by 1%, the bond fund will go up in value by, again, roughly a percentage equal to its duration. So they're both in the 6 range. So they're both pretty close. So, but if you look at how it's spread out, so 45% are in U.S. government bonds. I mean, do we care how many they own? I just don't think it matters. U.S. government bonds, U.S. government bond. Again, given that we're talking about the same duration, right? Obviously, a short-term U.S. government bond is very different than long-term. But here, we're talking for all practical purposes, same duration. And Vanguard is pretty close to the same percent, a little bit more, but whatever. Now, corporates, I suppose, on corporates, could you say that because maybe they have more, not percentage-wise, but number of bonds, that maybe there's more diversity? I mean, I suppose, but they're all investment grade. You can see that here, and Vanguard's is 2, right? And these percentages are roughly similar. So, and you're still talking about thousands of bonds. And then securitized, I guess, probably mortgage-backed, I guess, primarily be my guess, right? I personally would be fine with either one. I don't think, I was looking to see if there were any, if you could see any corporate bonds in here. We've seen a couple mortgage backed. I know I'm going through this quickly. There's a third one. Yeah, it's interesting. I wonder if these are, I don't know how this is structured. I would think we'd see corporates, but I'm wondering if do I need to see? No. Anyway, I'm just sort of mumbling at this point. I wouldn't lose any sleep over it either way. That's my view. Based on what have to have been 2, maybe 3 minutes of thought. Jeff wants me to compare VFIAX which is the S&P 500 with Wellington. Well, they're totally different. They're not really comparable, right? Because Wellington is a balanced fund, right? Meaning it owns stocks and bonds. It's also an actively managed fund. Now, an extremely good one with an amazing track record. But if we look at so we all know what an S&P 500 is, but if we look at Wellington and we go to the portfolio, you'll see it's roughly 60-40, not a little bit more in stock. But so they're totally, it's like apples and oranges. They serve 2 different purposes. You know, a lot of retirees will be in Wellington. I can't argue with it. It's done extremely well. And as an actively managed fund, it's really inexpensive. Whereas it's 16 basis points. That's cheap. Man, I was guessing it'd be twice that. I don't own it, but you know, it's probably one of the few actively managed funds I would if I thought it made sense for me. All right. HB is totally confused how to fix unclassified assets in personal capital. The percent must be 100. I don't know if I can help you out here, but I'll try. So personal capital offers a free dashboard. You can use it for budgeting, checking your expense ratios on your funds, your asset allocation. I like it a lot. They're an advertiser. I'm going to pull up the version that I have that I use as a demo, which is to say it's not my actual money. So here it is. These are just, as many of you know, I've created these over time. I haven't done this in a while, but to evaluate your all's portfolios. And let me see. If you go to investing, and I was just doing this the other day in my own, and I got to remember what I did. So there's going to be some we don't have any unclassified. That's funny. Not in a good way. Hang on, let me try something else. You may have looked at this, but this is the only thing I know to show you since, let me just double check. We don't have any unclassified. So if you just Google this, how do I classify unclassified holdings? It walks through how to do it. Now, maybe you've tried that and what you're trying to do hasn't worked. And then I would just I would submit a support ticket. They do respond to them. And I've done that from time to time. I was classifying treasury bills because if you look at like in a brokerage account, when you buy a treasury bill, it's all gobbledygook. I mean, and personal capital has no way of knowing what it is. So I classified it and didn't have any. It was pretty straightforward. But anyway, you could try that article that walks you through it. And if you've tried that and it still doesn't work, I would reach out to them. So David says, down 25% with no plans of taking withdrawals. Thank goodness for my pension, which covers all expenses. That's a really interesting point. You know, when you have some sources of guaranteed income, that too can help you stick to your investment plan. Now, I don't have a pension. You may not have a pension. Most of us should have Social Security. It can be a reason to annuitize. And it's interesting to me anyway. I don't own any annuities and don't have any plans at the moment to buy any. But one of the things I was trying to figure out is if you were going to annuitize part of your retirement portfolio, how would you figure out when it made sense to do it? And then how much of your portfolio would you annuitize? And I came across an article. Let me see if I can now find it. I don't know that I can. Oh, wait, maybe it was here. Hang on. Bear with me. I've got a couple different note-taking apps that I've been using and trying to move things around. So I'm pretty not very well organized. But it was just a new article, and I found it fascinating. Is this it? No. I'll try one more thing, and then if this doesn't work, well, I'll have to, oh, I know. Let me try this. Hang on. One more thing. No, I'll have to dig it up. I'll dig it up for next week if I can remember. But one of the things they said was, you can have too much money and just don't need annuities, or you can have too little money and it doesn't make any sense. All right, conceptually, I get that. So, but what's the answer? When do I need them? And what they were saying was, on the too much money, they put it at, if you had 36 times your expenses, which comes out to initial withdrawal rate, I think of 2.7. You don't need annuitizing doesn't make any sense. I really want to find this article, and I'm aggravated that I can't. Annuities, they had different strategies. I just can't remember. I'll find it as soon as the stream is over, I'm sure. I got to do better. Anyway, I'll find the article. But at least it was a starting point for figuring out, or at least getting one view of whether annuitizing some of your portfolio makes sense given your financial situation. And they looked at other alternatives, like they called it the Social Security bridge, I think, where you delay Social Security until you're 70, and the advantages and disadvantages of that. And it was a good article, which is why I saved it. And of course, now I can't find it because I'm not very good. Anyway, all right, that was not helpful. All right. Scrolling through, looking for my name. So Alex wants to know, what does it mean, reversion of or to the mean? So the idea is, let's say the average, we'll use PE ratio. So let's say the average historically has been 16. Right, that's the mean. But of course, it's rarely actually 16, right? Sometimes it's like now it's higher, sometimes it's lower. But the idea is, don't get too comfortable when it's high, or don't get too frightened when it's low. Eventually, it's going to go back in the direction of its average. Now, technically, that's not necessarily guaranteed, right? But that's the idea. Is over time you would expect it. You're not going to expect if the average is 16 and we're now at, well, it depends what PE you use, but let's just say we're at 25. And that means stock prices are up. Let's imagine. Well, they say, don't get too comfortable. It's going to eventually revert or go back towards the mean, the average. Now, a mathematician may have a more nuanced definition of reversion to the mean, but that's mine. And I have taken statistics twice, so I've got that going for me. I'm still bothered that I cannot find that article. Oh, well. All right. Skipping the banter. I have had one person ask the same question. I think I've answered it. Well, Craig, I just came across Craig's question. Does it make any sense to consider putting a small portion of my portfolio into an annuity? Yeah, and I've got a great paper for you. I just can't find it. Okay, I won't keep looking. Rand wants to know, does Berger always qualify his comments with "I may be wrong"? Well, I may be wrong, but I think I do. All right. Jack wants to know, thinking of new retirement software, would I be able to make a pension decision with it? I'm not sure what you mean by that. I guess you mean how to take the pension, because pension goes up over age 65. So you certainly could create alternative sort of what if scenarios, which is how I would handle this. I would say, okay, I'll come up with some base plan. I take my pension at whatever age, 60 or whatever it is. And then you could come up, and you get X dollars a month, let's say. And then you can come up with an alternative scenario where you take it, maybe you delay it, but you get a larger amount. And then you could compare the results. So you can do those sorts of things in new retirement. Let me log into my demo account. I won't be able to demonstrate this quite that way, I don't think. Yeah. So, but I can show you what I mean. So this is my demo account of new retirement. And when you sign in, this is what this sort of the dashboard, right? And here's where you put all of your data, including income, right? Which can include, as you see here, pensions. I don't have any in this demo account, but you could add a pension. And then down here where it says scenarios, right? All I've got is a base plan, but you could, I'll just say take pension at 68. Whoops, 687. I bet you get a lot if you waited till then. 68, right? There it is, and you could activate it. I'm not actually sure. There we go. So, and then you could come in here and make changes. I've never actually created multiple scenarios, so but yeah, it has that functionality. So Kelly wants to know, family member in the 70s has self-managed portion of traditional IRA, 100% in cash. Taxable is in contra and junk bonds. How would you help them? I don't know that I would. I mean, if they want to talk to me and get my views, I would, certainly offer them. I might, since you know what they have in their accounts, you've obviously discussed, I'm assuming, I shouldn't say obviously, but I'm assuming you've discussed it with them. So maybe they'd be open to hearing your views. But I probably wouldn't push too hard. That gets very dicey. Particularly if, as bad as that sounds to us, well, to me, to you, if they have enough money to live, and they're paying their bills and they're okay. I suppose, if they're the kind of individual that likes to learn a lot and self-study, suggest a book. You could suggest they talk to someone. A lot of times, particularly with money, it can help if they talk to a non-family member, like an investment advisor, but someone you trust that's, and maybe not even someone that's going to manage their money, but that's an option. But it gets really dicey with family and money. And I'm very careful about what I say to folks when it comes to how they handle their money. Yeah. Well, this question is Jurgen, I guess. Is it worth it to hold more cash right now to capitalize on expected decrease in housing values, or better to put it in the market? Well, I guess so. Is the question, should you hold on to cash and invest in a rental property? You say housing values, or are you looking to buy a home? I mean, those are two very different things. So obviously I don't know what will do better over a given period of time. I'm going to assume, by the way, I'll just assume you're thinking about maybe investing in real estate. There's no way to know which ones are going to do better between a rental property and, say, the stock, the S&P 500, let's say, over the next year, 5 years. There's no way to know. I don't know. I think they can both be good, right? I like the idea of investing in real estate if you're willing to do the work, and because it's a lot of work. Yeah, I'm trying to think of something else to say that would be of value to you. I don't think I can. The way I would think about that question for me, first of all, is, well, do I already have real estate investments? What does my market portfolio look like? That would be one question. So like now, I don't have any real estate. I like the idea of investing in real estate from a diversity perspective. And I don't mean REITs now. I mean actual property that I own and directly control. It's just that I don't want to take the time to find it and manage it. I don't want to pay people to do it, because that just drains the profits. I haven't ruled it out in the future, but it's a lot of work. So, that's a factor. But that sort of high level question, I think it's just almost impossible to answer. It just going to, and depending on the circumstances, they could both be good options potentially, right? So I've gotten this question someone emailed me. Josh says, "Can you explain again how to buy IBonds as a gift after you've reached your yearly max? I tried it and it said I tried it and it said I'm trying to exceed my yearly maximum." So I don't understand that. I've not done it yet, but plenty of people have told me they've done it successfully, and I've read all of the Treasury Direct information on it. So when you're buying something as a gift, the fact that you've already personally bought 10,000 is irrelevant. You do have to mark it as a gift, and when you put in the individual's name, you have to add them as a registrant if they're not already in your account. But so you need their social security number. You say, "I'm buying on their behalf. It's a gift. It should work." If I log in next week and try that and it doesn't work, I don't know. Can you call Treasury Direct? I'll get President Biden on the phone. Maybe he can help me out. I don't know who does that. I guess it'd be Yellen, really, right? It wouldn't be Biden. What am I saying? I'll call Janet Yellen, get her on the phone if she'll take my call, and probably wouldn't be her either, now that I think about it, but someone, hopefully. But I know it works. And I guess after I do it, I'll let you know. So that's interesting. I'm not sure. I'm seeing Noreen's comment. Here it is. I'll put it up on the screen. And my brother is texting me. I think he wants to play speed chess. Anyway, he might. I don't know. He doesn't know I'm doing a live show right now. So if I play him, I will put it on the screen so you guys can can watch. He may not be happy about that. I'll do 5-minute speed since I'm doing a live show. So anyway, back to the question. Let's see if he agrees to play me. Anyway, so I don't know. I mean, like I said, I've talked to a lot of folks who've done it without an issue, and that's how it works. So I would give them a call. So a person says, in regards to the video yesterday, 9% IBonds only good for 6 months. Wouldn't it be better to lock in funds a bit at lower rates with CDs for 6 to 7 years? Well, it would be significantly lower rates, right? As far as I know. But which one will turn out to be best? It's possible the CDs could turn out to be better, right? I mean, when you think about locking in for 7 years, what would 7 years get you? Here we go. Well, 5 years on a brokered CD get you 465. So let's just say it gets you that. That could turn out to be better, actually, right? Because what if the Fed gets inflation under control and the end of next year they lower rates, and now they're back down to something lower than 465, and you've locked in a beautiful CD for 7 years, making above market rates return on it. So you can imagine a scenario where, yeah, a CD would be better, which is to say, in some ways, that a nominal bond could be better than an inflation-adjusted bond. But that's just the point. We don't know. So I like to hedge my bets and have both. Now, I don't do it with CDs. I just do it with regular, bond fund. But it's possible that could work out to be better. But there's, as far as I know, there's no way to know that. So that's the issue, which is, just to put some context on that. David Swenson was the head of the Yale Endowment. He passed away a couple of years ago. He wrote a couple of good books. And one of them, I'll show it to you. Here it is. Unconventional Success, a Fundamental Approach to Personal Investment. I wouldn't describe this personally as the best book on investing, but I think it was a good one. But one of the things he talks about is dividing your portfolio, your bond portion of your portfolio, between, say, TIPS or inflation-protected bonds. He used TIPS, not IBonds, because TIPS can be publicly traded, so they can be part of funds. And nominal bonds, just regular bonds, right? And his approach, as I recall, was 50-50 in each, because you don't know where inflation's headed. Or at least that's his view. I tend to agree with it. I can't predict these sorts of things. And if inflation turns out to be higher than we expect, TIPS kind of win. If inflation turns out to be lower than we expect, the nominal bonds win. And you can see what the market's constantly changing on where it thinks, what the delta between those are. Because remember, when you buy a TIP, you're getting a lower yield than you would for a comparable regular bond, because you're getting that inflation protection. Like, it's almost like an insurance policy. You got to pay for it. You pay for it with a lower yield. And it's that spread represents between the two is what represents the market's view of inflation over that period of time. And you can see that. Let me see if I can pull it up real quick. Yeah. So the Fed has, this is for 10-year, the break even. And right now we're at 224, I guess. 222, 227, something like that. Anyway, you can see, down here, the spread was only 50 basis points, which was saying, look, the market's view of inflation over the next 10 years really, really low. But this was COVID, right? When everything was shut down, we couldn't have inflation. No one, we couldn't buy anything. We weren't going anywhere. It's obviously gone up. It was higher. In any event, so my view is I like a little of both. You could do it in the form of a CD, or that could be part of the plan. Anyway, a person, I hope that answers your question. I'm still trying to see if I can play my brother in speed and speed chess. It's just not happening. I'll try again. All right. Kelly mentions another YouTuber, diamondnestegg. And yeah, she has some great content on IBonds. So I highly recommend that. I've watched a couple of her videos. They're much fancier than mine. There's editing, no background music. So you got that going for you, because I know you guys don't like that. Whew. All right. Oh, here we go. HB. I screwed up with a click of the mouse. I rolled over my inherited IRA, I'm assuming, in 2018 to another brokerage. So far, the IRS thinks, I'm not sure I follow all that, but good luck. VJ, good to see you. How often do you look at your investments during a bear market? I mean, I certainly look at things weekly, sometimes daily. I certainly am watching the market daily. Part of it's just because of what I do. You know, some will say, don't look at it if it helps you not sell. And there are days when the market's down 3 or 4%, and I'm like, yeah, I ain't gonna look at my balances. But I wouldn't sell if I did. So I look at it pretty frequently. All right. So it's interesting. Milton says, if I remember correctly, I believe you're not a big fan of annuities. Was wondering if you're familiar with Stan, the Annuity Man. Is it a man or guy? I am, by the way. I get his email. Stan, the Annuity Man. Yeah, I guess so, because it rhymes. I should have seen that one. Here he is, or here's his site. I don't know anything about him. But from what I can tell, he's pretty knowledgeable about annuities. So I don't really have a recommendation one way or another. So Robert says, I have a CD with a 2% interest rate. So my question is, why not cash that in? I don't know what the penalty is. You'd want to figure that out. But I'm wondering, given current rates, even if there's a penalty, I would think you could make up for it. I mean, you could double. It depends what your term of the CD is. It's a question. All right. I'm bothered that so many people have had trouble buying IBonds as a gift. Remember, you got to check the box. I want to jump in there and do it, but just to see if it works for me. Maybe I'll buy one tomorrow. I wasn't going to. Maybe I'll do one tomorrow and then see if it works. Let me see something. Maybe I'll do it right now, live on the show. I won't show you my account. Let me check the balance in my checking account. I don't want to overdraft on something going to the U.S. government. I mean, that would be bad. Two-factor authentication. Okay, I do. I have the money. I got to set up the account though. That shouldn't be too hard. Of course, I could do it and I get the error. That'd be embarrassing in front of hundreds of people. Of course, if I get the error, I'll just call them tomorrow. And I'll report back to you. That's all. Not that difficult. All right. I'm logging in. Lots of security measures. I think I've got to prick my finger and put a drop of blood on the phone. It's not quite that bad. Here we go. Oh, I've got to type now. My eyesight, making sure I can read those numbers, letters. Okay, I'm in. Well, not really, but I'm past the first firewall. If for those that have accounts, you know what I'm doing right now as I click around this keyboard. All right. Buy direct. Series I. Submit. Add a new registration. Put my wife's name in. I know her social security number off the top of my noggin. I'm going to put myself in as the beneficiary. I'll do the opposite for her, you know, switch it around, but that makes sense. Oops. This is a gift. Oh, I got it. Hang on. I didn't check something. Oh, that messed it up. You got to be careful. If you mess things up, like sometimes then you've got to go to your bank and all kinds of crazy things to get things to work. So I added my wife as a new registration. That worked, and it's taken me back to the page where I can actually buy the IBond. But I've got to now select that new one, that new registration, because there's a drop down. Because I now have myself, you know, I've got my original registration, which is me with my wife as the beneficiary. But now I have to select her with me as the beneficiary because I'm buying a gift for her, right? And that's interesting. So when you set up the registration, I selected that it was a gift. So everything I buy for her, when I select her as the registrant, hope this is making sense, will be as a gift. But of course, that makes sense because this is my account, not hers. All right, we're going to try it. Single purchase. I'm kind of nervous. I mean, I hit and it doesn't work. And then it's like, I'm such a loser. I got the same error. So I'm a loser. That might be a little harsh. I will figure this out and I will get back to you. I'm going to try something. Yeah, I'm going to have to report back to you. I don't have an answer. But I'm going to get one. You know what I'll do? I will try to get the answer tomorrow. And I'll do a YouTube short, you know, 60-second video with the answer or an update. Is it 8:30 already? Wow. All right. You know, I like to scroll to the bottom when that happens. Jeff says, Rob Berger, now I don't feel so stupid. Yeah, no one's stupid. I don't know what the deal is, but we're going to figure it out. I'm just looking through the page to make sure I haven't missed something. Before we hang up, well, you guys can go anytime you want. going to Google it. Let's see. So I'm looking at this the Finance Bluff article that I linked to from the video itself, because he notes in that article that people have had this problem. He's walking through, oh, I can show you this. He's walking through how to set up your registration, which this is, there's the checkbox for this is a gift. I did that. Series I down here, did that. Select the registrant, yep. So I did everything that he said. So I'm going to have to just keep figuring this out. And I will. I'll get to the bottom of this. And I will report back to you. All right. So Bob says, what if wife is already registered as a bondholder? So if she already has a Treasury Direct account, that's fine, right? And in fact, the recipient has to have a Treasury Direct account, not when you buy it for them, but before you can deliver it to them. But that's perfectly fine. Now, if they've already bought their $10,000 this year, you can't buy more, or you can't deliver more. But maybe, I don't know, maybe they've changed the rules, or maybe what they're saying is you can't even buy the gift for them now if they've already purchased for that year. But that's not what everything I've read says. That's not how it works. So I will get to the bottom of it and I will let you know. So there you go. So yeah, sometimes we just got to plow through and figure it out, and I'll do that. Well, that's it. It's 8:32. I've gone over. Sorry to keep you. Thanks for joining me. It's always a lot of fun. Hopefully, maybe we learned something. I've learned at least one way that it doesn't work to buy an IBond as a gift, and I'll figure out if there's a way that it does work, and I will let you know. So until then, remember, the best thing money can buy is financial freedom, and subscribe to the channel if you haven't, and I will have that video one way or another. I'll let you know what in the heck happened.